There you go. You know this information is going to be held against me, right? Well, good morning again, everyone. It's really a pleasure to be with you. Back-to-back weeks, huh? Pretty cool. Cool for me. I'm not sure about for you, but I'm really happy to be with you today. And let's kind of pick up where we left off last time. It was the California clawback. If we had a picture of our state, our great state flag here, you would see a picture of our mascot, and that would be the bear, right? The bear has a claw. Well, California has what they call a clawback provision. What is that? Well, 3 times the state of California tried to pass legislation that would prevent you from exchanging outside of California. How do you like that? And so what happened, if you know, it's such a great state and everybody wants to be here, why do they have to pass a provision to go out? Kind of sounds like something else I've heard of once in the past, like, you know, in Europe or something. Anyway, so the bottom line is that California lost all 3 because we petitioned to Congress and the IRS, and they agreed and told California, you can't do that. So California then came up with a provision called the clawback provision. What is that? Well, let's say an exchanger decides to exchange outside of the state of California. Remember, you can exchange any domestic property for any domestic property. And not that it applies so much, but you could actually exchange foreign for foreign. So if I sold something in, let's say, Canada, and I wanted to exchange somewhere, you know, with all the peace treaties that are going on in the Middle East someplace, I can do that as a US taxpayer and do a foreign to foreign exchange or a domestic to domestic. But the government does not allow us to intermingle domestic and foreign together in under one exchange umbrella. That is not allowable. So let's say you decide to sell your property here in California. And right now, there sort of is a mass exodus of people who tend to be in the upper middle class to upper class financial provision, wherever they are, socioeconomic thing, where they're exchanging out of the state now because so California is kind of having a hard time right now. So the bottom line is that the state of California wants to track you because of this clawback provision. And basically what it means is that when you sell, if you cash out, California wants to go back and claw back whatever was owed to them when you originally left the state to do your 1031 exchange. They want to be paid. So what they force you to do is to file a form. It's in red. It's called Form 3840. Your CPA will do that with your tax return. It has to be filed every year because if you don't file it, they claw back. They assume that you sold the property. So the bottom line is they're going to chase you and they're going to get their money. So the bottom line is that file the form every year. That's all it is. It's one form and it keeps the claw from clawing back on the taxes that you deferred when you left California. Now, let's say you do an exchange, or let's say you buy in, let's say Nevada, for example. And you buy in Nevada, and especially in up north where there's a lot of construction and companies are moving to. I mean, you've seen Tesla's up there now. Amazon has built some big not factory, but warehouses and office complexes. Apple has put a big building up there. Google is in the process of breaking ground and doing that. And there's some others that are doing it as well, but it's very attractive for companies to go there. So let's say you exchange and you buy something out there because the prices of property are going through the roof because they can't build enough to house all the employees that they have out there. So what happens is you do an exchange and you buy an apartment complex, whatever. And then let's say 10 years later, you think it's cooling off a little bit, and then maybe you'd want to exchange to other places that you think would be good, like Nashville as an example. A lot of people exchanging in Tennessee, Florida, Texas, Idaho, and Arizona, amongst other places. So let's say you do another 1031 exchange. Then the 3840 form will show in the year that you exchange into that it will be filed that you did a sale. They cannot claw back because you did another 1031 exchange. But if you do sell the property in Nevada and you decide that, well, I'm just going to cash out, then California is allowed to claw back. Even if you go in a tax-free state like Texas or Nevada or Florida. So the bottom line is, be careful. Just remember to file this form, and because it allows the state to keep track of you until the replacement property is disposed of in a taxable sale. So just keep filing the form every year, and you don't have to deal with it. When your estate, you pass, the estate gets a stepped up basis. If you've got a trust or other types of vehicles to do it in, then California gets zero, nothing. So there you go. That's how the clawback works. And by the way, like Cheryl mentioned earlier, if you would like to stop me by unmuting yourself or putting a question in the chat box, I'll be happy to talk with you and answer your questions right there and then, because it's my pleasure to make sure that you understand everything, so you feel like you're properly, how can I say, well suited and prepared in the event that something comes up. And if you're not sure, call me or have your client call me. I'm happy to answer whatever questions you might have. Okay, next. We talked about this once upon a time when we did our regular classes, but I'd like to dive into it a little deeper because I'm getting so many questions about the reverse 1031 exchange. What exactly is a reverse exchange? Some people think it's when you open escrow on a purchase before you open escrow on a sale. Ladies and gentlemen, that is not a reverse exchange. See, the government doesn't care when any escrow is open. They really don't care. They always track closings. The closing of the sale with the closing of the purchase. We know that we can close simultaneously. We know that we can close the sale first. We can close the purchase up to 180 days later with a 45-day window to identify. And the government has given us language that now allows us to actually close the purchase first and the sale afterwards. And that's called a reverse exchange. Now, let's talk about that. What is the biggest issue or hindrance to wanting to sell a rental property and exchange? The answer is, right now, it's not interest rates. I got to tell you that. What it is basically inventory. There's not a lot to choose from. And remember, the purpose of the exchange is principally there for the purpose of growing your cash flow, your income. The second purpose is to be able to create more appreciation. The third purpose is to create more income tax write-offs. That's the motivation, to diversify your portfolio, to not put all your equity in one property. So if you're going to do an exchange and then you have a deadline of 45 days after the sale closes to identify, remember, the government doesn't care when you open escrow. So you can open your escrow on your purchase first and then open escrow on your sale later. It's when you close is what they're looking at. And the reverse exchange allows you to close a purchase first. Now, why would I want to do that? There are at least 3 reasons to do so. And any one of these reasons may motivate your client to do this reverse exchange. Number 1, I don't know if you can hear that. That's called opportunity knocking. What that basically means is you find a property or it comes to you or it's an opportunity. Remember, as investors, we exchange because of opportunity to grow. A homeowner is completely different. They sell because they have a need. Here, you don't necessarily have a need. Because you're into this to make more money. So what happens is a property comes knocking at your door. It's in a great location. It's an incredible price. Maybe it's got a lot less deferred maintenance than your property has. And the bottom line is you have a chance to acquire it at maybe under market price. But the seller wants, let's say, a 30-day escrow. And you know that it's going to go to another buyer, because opportunity, if you don't answer it the first knock, it's going to go to somebody else. You want this property. It's perfect for your real estate portfolio, but you need to close the purchase first. The reverse exchange will let you do that. Here's a second reason why some investors do a reverse exchange. They're petrified to sell for fear that they can't find the right replacement property, because the purpose is to make more money. And why would you want to take a chance with a 45-day deadline after the sale closes to not find exactly what you want? And then ultimately either buy something you don't want to not pay the tax, which is bad, or even worse, you don't buy anything and then pay the whole tax. So the bottom line is that the reverse exchange allows you to wait and to seek out the right property for your client. And then they could close the purchase first through the accommodator, and then close the sale up to 180 days later. Just the opposite of a normal delayed exchange. You close the sale, then you have to close a purchase within 180 days. This is backwards. You close the purchase first, and then the sale up to 180 days. Some people can't sleep at night knowing that they have to find the right property, and they know they can sell in this marketplace. The question is, can they find something that's going to be better to go into, to diversify, to create more income, tax write-offs, and all the other things, appreciation that we talked about. So the bottom line is, that's the second reason why somebody would want to do a reverse exchange. The third reason why somebody would want to do a reverse exchange: you have planned it right. You have played this out. You planned it. It's all falling into fruition. Your sale's going to close escrow in 2 weeks. Your purchase is going to close in 3 weeks. You only have a gap of a week between the closing of the sale and the closing of the purchase. You have done a good job, except for one problem. Your buyer falls out of escrow, can't get loan approval, changes their mind, decides to buy something else, or just gets buyer's remorse. You ever seen that before? Well, all of a sudden, as an exchanger, you have no more delayed exchange, because you're going to close your purchase in 3 weeks, and that seller's not going to budge, or they'll sell it for a higher price to somebody else. You've got them locked in. So the bottom line is, a reverse exchange would be perfect in that situation, because it allows you to continue to go forward with the acquisition that you want, and then close the sale up to 180 days later. Sounds good? It is good. It's a great way to do this. However, you have to know that there's 2 things that are involved in a reverse exchange. Really 3. Number 1, if you look at the bottom in red, eat. That's something that maybe some of us did before we sign on, or we'll do it after we get off today. But that's not the kind of thing we're talking about. EAT stands for a upfront holding corporation, an exchange accommodation title holder. That's what EAT stands for. The accommodator must create either an LLC or a corporation. We prefer a corporation, to take title to the property you're selling the day before you close your new purchase. So first thing, our responsibilities to the client is, not only will the paperwork increase by 10-fold, but we have to create this holding corporation. Now, the government doesn't say how many properties you can put in that corporation. Therefore, some companies put all their properties, let's say they have, 40 reverse exchanges or 20 reverse exchanges going on at one time. So they'll put 20 properties in a corporation or an LLC. Bad, bad, bad. Because if something happens and somebody trips on one of those properties, and they decide to call one of these lawyers that are just up and down 101, or down here where I live, where there's nothing but law ads saying, have you got ripped off? Have you been injured? Blah, blah, blah. You are entitled to money. And they decide to sue the owner of that property. And it happens to be in a LLC or a corporation of the accommodators with other properties, that's who they're suing and all their assets. And that includes your client's properties. You should never do business with an accommodator in a reverse exchange that stacks properties in it. It should be one corporation or one LLC per property. That's it. Number two, that has to be established, this holding corporation. We deed the property you're selling, assuming you're going to get a loan, into that corporation no later than the day before you close the new purchase. The day we put your relinquished property in this holding corporation, because the government won't let you have title to both at the same time. See, what happens is they feel that if you took title to the new purchase and holding title to the sale property, what you're going to do is then sell the sale property. And say you're exchanging into what you're going to buy is the one you're already held title to that you already bought before. And the government says you can't do that in a 1031 exchange. You could only buy something that you don't have. So either we hold title to the property you're buying until your sale closes within 180 days, or we're most likely going to take title to the property you're selling. And we hold that the day before you close your purchase for a maximum of 180 days, which means you got to close that sale of that property that we're holding. It'll be deeded to the buyer, and now you have a good reverse exchange. It allowed you to close the purchase first and then close the sale up to 180 days later, depending on what we're going to hold title to.
So
Number
Phil,
three.
real quick, can I ask a question? So what is pricing typically? Is it more expensive to do a reverse exchange versus a 1031 exchange?
Yeah, well, they're both 1031 exchanges. The difference is one is a delayed exchange, the other one's a reverse exchange.
Got it.
You don't have to clarify that in your RPA or anything like that. It just has to be a 1031 exchange because that's all it is. But yes, you could imagine with 10 times more paperwork, setting up a corporation. With our company, you're dealing directly with the legal department, and they're doing all the documents. And then ultimately, that single corporation for that single purpose, then what'll happen is after we close the sale of the relinquished property, we dissolve the corporation, so it will not be used again. And then we have to do a tax return. So yeah, that costs more money. A typical delayed exchange is $950 from one sale to one purchase. A reverse exchange is somewhere between $7,000 and $8,000. Now, let me ask you a question. Yes, it costs more. There's no doubt about it. And personally, if it was up to me, I would rather do a delayed exchange because that's my money. But this is what I want you to think about. Is that property worth that you really want to buy and want to close on an additional $6,000 or $7,000 in fees? Would you pay $7,000 more for that property to get it? If the answer is yes, and you're talking about hundreds of thousands or millions of dollars in terms of a property, do you really think $7,000 is going to influence that exchanger? Most of them say, where do I sign? How do I get this started? And that's how because that's how they see it. They look at the big picture. This is the right property for me. It's worth it. And I have such a high or low basis in the property I'm selling, a very high capital gain, that I'm going to spend tens of thousands or hundreds of thousands of dollars in capital gains taxes. To pay $7,000 more for an exchange is well worth it. And that's the way most clients see it. Now, some don't. If they don't, then they shouldn't do a reverse exchange. Do a delayed exchange, and I hope you find what you need to find in a market where there's not a lot of inventory with a 45-day limit. But it's up to the client to decide. We're not here to push them into a reverse exchange.
Hey, Phil, I have a question for you.
Yeah, Manny.
When you do a reverse exchange and you purchase the property first, you have to have, obviously you have to have the cash to complete that purchase. When you buy the other property,
what happens?
The property you sell, the money goes into this corporation, is what you're saying? If you sell first?
The property does. So let me explain. I was just literally really starting to talk about it.
Okay,
And that's when you
sorry.
jump in. No, sorry. Your timing's perfect, actually. This is how it works. You have to have upfront cash, or if you don't have enough cash to buy the building, then you put upfront cash and then you get a loan. It could be a new purchase money loan. It could be a hard money loan. It could be a swing loan or a bridge loan or a line of credit or refinancing your home or whatever, or another property you have. It doesn't matter. What happens is you come up with cash, and if necessary, you come up with a loan. And then you acquire this new property, and before you close the acquisition, that's when you deed the relinquished property to this EAT, this exchange accommodation title holder. When that sale property that we're holding for you closes escrow, first thing that's going to be paid off are closing costs and debt to the property. The rest is cash. You can pay to pay down or to eliminate the swing loans, the bridge loans, the hard money, the line of credit, and you're allowed to reimburse yourself for the cash that you had to pull out of your bank account to acquire this new property. So it's all reimbursable, and that's how it works. So you get all your cash back.
That sounds fine. And you know, one of the other benefits I see to a reverse mortgage is if it's high risk, especially in this market right now, trying to purchase something, even if you identify those properties and then make offers and don't get any of those accepted, you run the risk of the capital gains taxes, which is much higher than the $7,000 for setting.
You know, Manny,
Reverse 1031 exchange, I mean.
Yeah, I know what you mean. Let me tell you something. You know what is a big issue right now? Fire insurance. That's a problem, and it's not getting better. And you have to make sure you got all your ducks in line. Lenders are getting more and more squeamish of lending money in shrub type areas. So, you know, you've got to make sure all your ducks are in line. And if you can do that and then close that purchase, now you're free to close the sale after that, because you've got your bird in hand as opposed to an identification with three in the bush. Does that make sense? So that's why some people like the reverse exchange. Now, is it for everybody? Absolutely not. I mean, I can tell you, you know, we're one of the largest independents in the country. We specialize in the reverse exchange. Still, just under 10% of all new exchanges that we open up every month are reverses, under 10%. So people still do delayed exchanges. This is if you have to close a purchase first and you don't want to lose that property, or remember, you know, you can't sleep at night and you have to have a secured property, one in hand. So it'll allow you because you feel like you can sell in a market like this. Or the bottom line is that you got two properties in escrow and your sale just fell out and you got to close this purchase. These are really the three purposes of using a reverse exchange. Make sense?
Yep.
Okay, there's one more I don't know if I have it on my list here. Let me just peek real quick. Yeah, it does. This is called a hybrid exchange. You know what a hybrid car is? Now there's three kinds of car: gasoline, hybrid, and electric. Electric car runs 100% like a Tesla. And now I guess Audi has 100% electric, and I think some GM and Ford has it too. Most of them have it. Some cars are what they call a hybrid. It's not a gas, but it runs on gas. And it's not 100% electricity, but it runs on electricity too. It's a hybrid. It runs on both. Like a Toyota Prius, as an example. There's lots of hybrid cars. The government has allowed us now to do a hybrid exchange. What the heck is that? Well, let's say I'm selling 3 properties, okay? And I'm gonna buy one really large property with that. Let's say that's my plan. So what happens is you have 3 separate properties. Now, guess what? I'm not a betting guy, but I'm willing to put a wager up with you. You're not going to close all 3 sales at the same time. You're not that lucky. Neither am I, and neither is your client. But the bottom line is, so when does the 45 days start ticking on a delayed exchange? For the 180 days and the 45 days? On the close of the first sale, the close of the second sale, or the close of the third sale? Now, I want you to think like the government. I just gave you a hint. So you know the answer is on the first sale. As soon as the first sale closes, you have 180 days to close what you're going to buy. And before you close what you got to buy, you got to close property number 2 and property number 3, so it can all go into the acquisition of the same replacement property. The government will let you do that. You can buy, you can batch multiple properties to acquire one of equal or greater value of the 3. You could actually do it the other way around. You can sell one property to buy 3, but you're probably not going to close all the ones you're going to acquire simultaneously either. So this is what the government does on a hybrid exchange. Let's go back to my example. I'm selling 3 to buy 1. It works both ways. I close the first one. That starts the 180 days when I have to close my purchase and the 45 days to identify it. I close my second sale before my purchase. Then I got to close my third sale before my purchase. Well, sometimes, you know, what's that old saying that the plans of mice and men, you know, sometimes our plans don't always work out. What happens if I can't close property number 3? We had a guy like that. He's out in Ontario. He had 3 factories. He wanted to put all his employees in all his factories under one roof. So he closed the first sale, he closed the second sale, and he identified in 45 days, and his 180 days was running out, and he had to close his new really big factory. But he couldn't close the third property in time. Here it is when we enter the hybrid exchange. Remember when we just talked about the reverse exchange? The reverse exchange is to do what? Close a purchase before a sale. So when we set up his purchase, 2/3 of his purchase was part of his delayed exchange of the 2 properties that had previously closed. We're going to set up what we did is set up 1/3 of that as a reverse exchange. So now 1/3 of that acquisition, and the government approves this. They're the ones who gave us the regulations on this, that we set up that 1/3 portion as a reverse exchange, which means it gave our client an additional 180 days to close the third sale. So now the government allows you via hybrid, part delayed, part reverse, to put it all into one replacement property. That's an incredible thing that the government actually did for us. And we're really grateful for it because it's helped a lot of folks who are selling multiple or buying multiples, and they can't get the timing straight because it's out of their control, right? So the bottom line is you can do it all in one set. Now that's even more expensive than the reverse, because we're going to charge you the $7,000 to $8,000 on the reverse plus the delayed exchange portion. Is it worth it to them? It sure is. Or they pay a boatload of taxes. And now they've got everything under what they wanted, either one roof or multiple roofs if they're diversifying, and it just works perfectly. Any other questions about that? This is supposed to be my shake, but okay. All right. There's also something called a bill to suit exchange. You might remember from our previous time that times that we've met together on Zoom here. What happens is, remember we were saying that if you need to do improvements to the property or repairs to the property, you can't hold back cash from the sale because you have to reinvest all the cash from the sale into the actual closing of the purchase. Well, the government still feels that way, and they haven't changed the rules. But the government has allowed now something called a build-to-suit exchange, also known as a construction exchange, which allows you to take the proceeds of the sale to not only acquire the new property, but to also build the improvements on the property that you want. Let me explain how that works. Remember, you can't hold back cash. From the time you close your acquisition and you take title to that property, any cash that's left over is taxable. So after you pay the taxes on whatever money you held back, then you can do whatever you need to do to the property. You can fix it, you can paint it, whatever, improve it, whatever. But under this build-to-suit exchange, the government's made provision, but it's not easy. The build-to-suit exchange says you're going to close your sale and then close your purchase as quickly as you can, hopefully almost simultaneously with your sale. But you will not take title, your client will not take title of the property. We will. We're going to set up a holding corporation that the client will identify the property that they're going to exchange into eventually, and they have to take title to it within 180 days. And they also have to identify all the capital improvements, not repairs, but capital improvements they're going to do to the property. So we set up the holding corporation, we set up the sale, and we set up the purchase, but not for the client. We're going to use the client's money, and they give us the authorization to move the money out of the holding account to buy and close the acquisition of the property, but not for them, for us and that corporation. With the remaining cash that we have that came out of their sale, they're going to direct us to the contractor to write checks or to wire to them, an initial deposit, and then of course they want their sales in increments or their income in increments. They'll pay for, lumber and materials and labor and whatnot. In the meantime, while they don't have title of the property, we do. They're building all the improvements, which means they could either buy vacant land or they can buy something that they just want to improve. And we're distributing all the cash as per the client's request to the contractor. And time is ticking because they have to still take title within 180 days from the time the sale closes. So what happens is we then at the end of the 180 days will deed that property to the client. They identified the property in the 45 days. They identified all the labor and the materials that was going, or plans that was going to go into that property for the building or the construction or the improvement of that property. And then ultimately they take title to it at the end of the 180 days. So what happens is they were able to sell at $1 million, buy something for 600 or 700,000, and then use the remaining cash to build the improvements. Now the improvements may not be finished, and they don't necessarily have to be finished. It's kind of obscure, but the government says it kind of has to look like what it's going to look like. So in other words, if you identified it's going to be a 2-story building and you only have 1 story built, that's probably not going to cut it. So my recommendation is that they take photos as they go through the phases over weeks of the construction of the property, and then finish the completion of the property after they take title on day 180.
So Phil,
And,
can I stop you real quick?
Yeah, this is a complicated exchange.
Yeah, it is.
Go ahead.
So how many investors choose to use this type of exchange? That's the first
Not a
one.
lot.
Okay.
Not a lot. We do it for restaurants or commercial buildings. We do it for, sometimes we have a client who has a property they really want to own. And the deal is that they just need to put some improvements of the property, but they want it to come out of the exchange funds. Now they're going to have to pay us a lot of money to do this because this begins at $9,000 to do our build-to-suit exchange. But is it worth it to some investors? The answer is yes. So this is like half of what we do on reverse exchange. So I say maybe 5% of the exchanges we do are build-to-suit. And the reason why I'm walking you through all this information that you may or may not use Your goal is not to know and understand and memorize it. Your goal is to know is that it exists. So if your client really wants to do something like that, have them call. We'll explain it to them. Not all accommodators are set up to do something like that. We happen to specialize it inside of our legal department. But the bottom line is that it's there if your client has a need to build an improvement. I had a guy call me last week. He's buying a property up in Montana, but he needs to build a barn. So he wants us, and he doesn't want to spend all that money to build the barn out of his pocket. He wants it to come out of the proceeds of the sale. So what happens is we set up the holding corporation, we get title to the farm, they will build the barn, and then it will be deeded to him. And it works because it's all used in a trade or business or investment. Therefore, it qualifies for the exchange and it qualifies for the money to build the improvements within the cash of the exchange. That makes sense, Cheryl?
Yes, it does. Thank you.
Oh, you're welcome.
Thank you.
You're not going to see a lot of it, but it's out there. And considering where you are, geographically speaking, the likelihood of doing a build-to-suit exchange is probably greater than it is here in LA. So I think you would at least know that exists. And I'd be happy to share with you additional information that actually goes over it. So if your client has any questions, give me a call. I'll email this to you or send me an email, whatever, and give that to your client. It's got our contact information so they can at least call and ask questions. Obviously, there's no obligation for that. So, okay, next. Are you still with me?
Yes, we're
Have I
still
put you to
with
sleep
you.
yet?
We've still retained all of our participants, so this is good.
Oh, that's good. Good.
Everybody should stand up, take a deep breath, do some jumping jacks.
Yeah, no kidding. Because this is a mind bender.
Yeah.
Okay. Have you ever had a buyer ask your seller to carry back? Happens. Guess what? There are tax ramifications for doing that. Why? Because if I'm selling for $1 million and the buyer is asking me to carry back $200,000 as a note and deed of trust for them, that's not a problem. But the problem is this: if it's a rental property and I'm doing a 1031 exchange, that $200,000 is going to be paid to me over the provisions of the note and the deed of trust. It's going to dictate the interest rate. It's going to dictate if it's principal and interest on the payments, or if it's going to be just interest only with a balloon at the end. It's going to include everything that you need to know. So let's say they do this, they do carry back, and they carry back $200,000. Well, let's say they have a provision for 7 years. And the bottom line is they negotiate a 5% interest rate or a 6% interest rate, right? So they're paying these payments, principal and interest, at that interest rate. Guess what happens? That money's not going into the purchase of the new property. It's going into their pocket because they're touching it. Therefore, that $200,000 that they carried back is completely taxable, 100%. Long-term capital gains, healthcare program, depending on how much they carry back, recaptured depreciation, and California state tax. That could be 30 to 40%, folks. So the bottom line is that carrying back is not a good deal unless you just want to pay the tax over installments over the next few years on that $200,000. Or you can do a carryback exchange. Now put on your seatbelts. What is a carryback exchange? A carryback exchange is when whatever you're going to carry back, you can cover because you've got the money in the bank. All right, that's a simplified way of putting it. If you're going to carry back $200,000, you, the seller, have to have $200,000 in the bank. Number two, we set up the exchange as a carryback exchange, where we technically, the QI, the accommodator, that's us, sets up the note and deeds of trust with the escrow. So the note is written on what they've agreed to. The deed of trust is going to be recorded. And the bottom line is that you would receive the income every month. But if you're going to do a carry back exchange, this is what happens. As soon as the sale closes, escrow is going to wire us the proceeds minus the $200,000 that you carry back. At the close of the sale, your client's going to take their $200,000 that they have in the bank, and they're going to wire it to us to exchange resources. And as a substitute for that cash, we're going to assign the note and the deed of trust to the seller. So now, technically, they've replaced the cash. They never touched anything. They've been given, for the new $200,000 they gave us to replace that cash on the carryback, they've been assigned the note and deed of trust. So now, over the next few years, as they collect this note or this deed of trust, the installment payments that are being made on it, it becomes interest taxable, but not capital gains taxable. So I don't have to pay all those capital gains taxes.
And how often do you see this being done, Phil?
Not a lot, but it's out there and it has to be used periodically.
Yeah.
And it saves your deals sometimes. And it saves a buyer, because if that buyer absolutely has to have a carryback and there's no way they're going to buy that property unless you do that, and you're not getting a lot of offers on your property, this can save.
Got it.
All right. So basically, but one last thing, if your buyer defaults, guess what you do? You foreclose. You keep all the money that you got, and then you get the property back, assuming that you're in first position. So, yeah, it's interesting. I know people who do this because they know they can get a property back if they don't get paid back, and they think the property is worth more, plus they get all their money. So kind of an awkward situation, but it is available on a carryback if you need to. But if you don't do this, it's taxable. It's boot. The $200,000 would be boot. How about mobile homes? You have any of those out there? I know we do down here. Or you have leasehold.
Quite a few.
Yeah. Well, you know how sometimes you either pay rent or you sign up a lease. You have a leasehold interest in the property. Well, guess what the government says? That if you're going to exchange that, you have to go back into another property with the same leasehold interest. So what happens if you have a 15-year remaining balance on the lease? You have to buy something with a 15-year lease to not pay any taxes on that. Or you can, oops, I forgot to silence my phone. All right. So what happens is that the government says that the property you're selling, if it has 30 years remaining on the lease or more, now get that, 30 years or more, that includes extensions that you can utilize that are in the contract. The government then will consider this as real property. The IRS has said if there's 30-year balance remaining on the lease or greater, you could actually buy a property, not leasehold. You could actually acquire it and take title to the property. They will let you do that. But remember, when you're selling a mobile home, do you own the property? Or do you have a leasehold interest in that property for 30 years or longer? Because if it's not attached to the ground and you don't have that 30 years or more, and then you don't have, or you don't own the property itself, guess what? That mobile home is personal property now. It's not real property. It's not affixed to the ground. So these are on a case-by-case basis. We do these probably as much as build-to-suit exchanges, but they don't have a lot. We don't see a ton of it, but this can solve a problem for your client. And I just did one with somebody up in Thousand Oaks area, South Ventura County. So that's just recently. So it does happen. So in the event that you get a listing and something like that, give us a call. We'll help you and we'll explain the answers to the questions. All right. Oh, there was a couple other things that I don't recall that we talked about. Can I move it? How are we doing on? Oh my goodness, time is passing quickly.
Yeah, we have about 10 minutes or so.
Okay.
Yeah.
I want to talk about this. Can I move into the property that I exchange into? I had somebody this morning ask me that question before I got on with you. I get that
No.
question probably more than any other question that I get, other than identification. Is it possible to convert that property into a personal residence? The answer is possible. But if you get caught and the government doesn't think that you had always had the intent to convert that into your retirement home, into your personal residence, they have a real problem with that. And they can disallow your exchange. Because remember, to do a 1031 exchange, you have to go into what they call a like-kind property. We know that's any investment real estate. So remember, you cannot, first of all, don't give tax advice out. And telling them that they can convert that property into a personal residence after 2 years is giving them tax advice. And you can't do that because they will sue you. So here's the deal, is that you have to buy with the intent to hold. But if something changes, you can convert it into a personal residence, something that was unforeseen and unexpected, like a health change or a massive family change or some kind of really bad financial downturn in your life and you had no choice. If your CPA feels that you qualify for something with no intent to have done this, after 2 years, it can be, but it has to be by the approval of not me and not you, but by the CPA. That makes sense? So be careful. I've seen too much of this happen, and be careful. Manny, did you have a question? I thought I saw your picture show up for just a second.
No, you answered the question.
Okay, good. Okay, lastly, remember the purpose of the exchange, since we're ending, is to grow income, to grow appreciation, to call tax write-offs. Remember last time we talked about recurring versus non-recurring closing costs. What is allowable? Purchase expenses are usually not allowable in a 1031 exchange. What do you mean purchase expenses? Well, if the lender is going to charge you appraisal, if they're going to charge you points, they're going to charge you fees, underwriting fees or whatever, that cannot be paid for from the proceeds of a 1031 exchange. Nothing can go to the lender because the government's position, not mine, but the IRS's position is that you're buying a loan, not property, with that money you're paying the lender. Therefore, it's not allowable. You can't pay for these fees from the proceeds of the sale to the lender. Did you know, now, well, I mean, we're talking about placer title here, right? Did you know that the lender requires a title insurance policy for what they're going to lend you? That also is not allowable. That can only come from your own personal proceeds. If you pay for that with the proceeds of the sale, it's boot, it's taxable. So be careful. Nothing on the purchase other than really escrow and your personal inspection, those are non-recurring costs to acquire. But other than that, almost everything else is taxable. It's boot, it's recurring. So be careful on what you pay for on closing costs on your acquisition. Remember, your majority of your closing costs are going to come from the sale. Commissions, escrow, title insurance. Now that you're providing a policy of title insurance from you to the buyer, that's a required contractual obligation. You have to do that. Transfer taxes, recording fees, my fees. Those all can come out of the proceeds of the sale. But on the purchase, whole different deal. Very little can come out of that. So remember, appraisals, no. Title insurance, no. Points or fees, no. Remember, personal inspections, yes. Escrow, yes. Be careful on that.
So Phil, let me ask you back on that real quick. You said on the purchase. So if the buyer, never mind. I think I just
Buyer of the exchange, right? They're buying their uplay.
Right. Okay, never mind. I just answered my own question as I was walking myself through it. Never mind.
You know what? That happens to me a lot. I understand that. I called the legal department and I said, never mind, I just figured it out.
Okay, I just want to make sure, did everyone understand that? Because
that's a touchy subject.
Yeah, it is. Okay.
Lastly, you have to replace debt. and you have to replace cash. Remember, you just can't walk away from a mortgage when you close the sale. You have to replace it or you're going to be paid, you'll pay taxes on it. And you have to replace all the cash. What you're not replacing is the one-time non-recurring cost to sell. And on the purchase, the escrow and not the appraisal, but the inspection. And that's allowed to come out of your closing costs. The government will let you do that. Let me see here. Okay, let's go. I already answered all this stuff on other times. Oh, here's one I didn't talk about last time. You ever heard of a 1033 exchange? It's very interesting. A 1033 is a threat of eminent domain, hostile takeover, condemnation. In those types of 1033, when the state or the feds or the city or the county or the school district wants your property, they will tell you you can do this. A 1033 exchange does not involve an accommodator. You don't need an accommodator. Number two, there's no 45-day identification period. You don't have to identify. Number three, guess what? There's no 180 days either. The government will either give you, and they'll tell you right there, 2 years or 3 years to replace, which is really cool. So the bottom line is that it can take you 2 to 3 years and you can hold your own funds. But the definition of like kind is different on a 1033 than it is a 1031. You can't go to vacant land if you're selling a building, or if you're selling a farm. You can't buy units or single family. So it's more stringent in terms of like kind definition, but it gives you some privileges too. Okay, lastly, 75% of what you do, maybe as high as 80%, is getting in front of people. There are placer title can give you the farm package of farms, vacant land, single family, condominium, 2 to 4, 5 and above, or any kind of commercial building, whether it's a gas station or a car wash or a storage facility, fast food, whatever. Skyscraper for that matter. I would recommend that you consider whatever you feel the most comfortable with to get this information from your rep at Placer. Why? Because this is what's going to happen. They will give you the records of those properties that have been held for 10 years or longer. That includes 12, 15, 20, 25, 30 years. Those are equity-rich properties for the most part. Maybe it's time to re-leverage the equity to buy something else that's going to be income producing, or to go into a triple net lease like a CVS building, or owning Starbucks as your tenant, or a shopping center, maybe 99-cent store, whatever it happens to be. You can go into anything that you want to buy and set up a relationship with these people based on questions that deal with cash flow, with how much return am I getting on the equity in my building? Can I raise the level of appreciation and go into something different? Or I just want out of management. I don't want to do this anymore. There's lots of different reasons. And if you didn't ask for them last time, we have like 16, 17 different pieces on communicating between you and them, or people who live out of state, who have left the state, who still own property here, on how they can do a 1031 exchange and go into something that's going to better suit them for the remainder of their life, create more income, get out of management, or bring it closer to them wherever they live. Placer Title can give you that. I will give you the marketing letters if you ask for them. That's my email address, phil@gmail.com. That's my phone number if you're here and you want to ask a question. Well, we called ourselves Exchange Resources because I'm one of the founders of the company. When we first left the big title company and started our own gig, we called it Exchange Resources because we specialize in the exchange and we want to be a resource to give you information with no obligation. That's why I'm doing this today. But like you, I understand you have to build a relationship based on not only service, but information and helping people think through what's important to them. It's never to sell. So there you have it. That's why we've met the last 2 weeks and all those other times. And who knows, maybe Cheryl will call me up and say, Phil, it's later in the year now, or at the beginning of next year, or whatever it happens to be. Let's do another series on this again. Either way, it's always my pleasure to volunteer to give you the information or to speak with your client and make sure they have the questions they need, and then I just send them back to you. Whether they exchange or not is up to them. Whether they use me or not is up to them.
Well,
But the bottom line is, this is the way to increase your business.
absolutely. So let me ask you a question on behalf of the agents and or lenders that we have here on the call. You know, some might feel a little intimidated once they start working or going after the investors. If they get someone engaged in conversation, can they call you and you can then work with them one-on-one with that investor to explain these things till they get to know it a little better?
What a leading
lot of
question,
information.
Cheryl.
What's that?
What a leading question. It takes one to know one, right? A title person. Here's the answer. How do I help you make money? The answer is to be available to you to answer your client's question. And then I'm done, unless the client wants to call me back. Or if they want to come back because you sold the property, now they want to do a 1031 exchange. I'm here to support you. And there's no obligation to that. So if you want to set up a Zoom call or or a conference call, or just have them call me. Just yesterday, I had like 3 requests. Can you please talk to my client? Would you please answer their questions? I'm happy to do that. Or I'll send you an email that goes over that information with my contact information that goes over, how the exchange works. And then ultimately, they can call me. There's no obligation for that. And I mean that very sincerely. I've learned in all these years, since 1982, when I first went into title, that the key is never to sell. It's to educate and bring information so my clients can benefit out of it. And if they can benefit out of it, guess what it does for me? It's that simple. Thank you.
Thank you. Thank you, Phil. You're a wealth of information, and I actually think that we possibly could schedule something in the next few weeks, go right back around to that basic 1031 exchange and go over that. We had a couple of folks on the call today that have not attended those previous trainings, so you and I'll chat afterwards.
Sure, absolutely.
I just want to say thank you to everyone. It was a lot of information and everyone stayed on here. Thank you for the questions. I did record this. I will get this sent over to our IT department so they can convert this to a link, a YouTube link, because it's too big for me just to email. That will take a couple of days. I did send out the link from last week. If you didn't get it, let me know, text me or put something in the chat box. And we're grateful. We're grateful for you, Phil, and I'm grateful for everyone on this call.
Thank you, Cheryl. And Cheryl, I just had a little brain thought. How about this? How about if those of you who are listening to my voice right now have relationship with investor clients, or you've been using our marketing materials and Placer's information on the farm to be able to reach out to these people? How about if we do an investor seminar? Placer will set it up. We'll all have Zoom links and your clients can log in and just listen and ask questions. They say that with every dark cloud, there's a silver lining. Well, I want to tell you the silver lining to this COVID thing. It's this. We can do it right there and then, and they don't have to go anyplace other than sitting in front of their computer and asking a question if that's what they want to do. It is amazing how many times it's going to be altered because I'm speaking now to investors, not just to real estate people. So what happens is, it's amazing. Every time I do this, new businesses always comes out of it for somebody. And the bottom line is, I've had people call me back 3 years, not via Zoom, but when I actually spoke at an investor seminar, they hung on to the materials and he said 3 years later, said, I'm ready to sell.
Awesome. That's a great idea.
So we'll leave that up to you and to your agents on board or lenders or CPAs or whoever's on board. Happy to do it. All the best to all of you. I hope it'll be a great last quarter coming up because it's going to be here before you know it.
Awesome. Well, everyone, go out there. Have an awesome day. Don't forget to call one of your placer title reps. We're here to help you with anything you need, and call Phil. So thank you.
You're welcome. Have a good day,
Bye.
everybody.
Bye.
Thanks, Cheryl.
You're welcome. Bye.
Bye.